At 9:42 p.m., a notification buzzes on a phone. Your balance is low. Not empty, not overdrawn, just low. The person sighs, transfers a little money, and moves on. Nothing feels wrong. But something very expensive just happened. Because the biggest banking mistake in America doesn't look like a mistake. It looks normal. It looks responsible. It looks like adulthood. And quietly, month after month, it drains billions of dollars from people who think they're doing everything right. This isn't about scams. It's not about fraud. It's not even about bad spending habits. It's about how the modern banking system is designed, and the one assumption almost everyone makes that turns their own bank account into a slow leak. Right now, Americans are more stressed about money than at any point in the last decade. Inflation cooled, but prices didn't come back down. Interest rates are high. Credit card balances are at record levels. Savings rates are fragile. And in the middle of all that, banks are posting some of the strongest profits in their history. That contrast isn't an accident. To understand why, we need to start with a simple idea that most people were taught growing up. Put your money in the bank. Keep it safe. Let it sit there until you need it. That advice made sense once. Decades ago, a savings account actually did something. It paid you. Not a lot, but enough to matter. In the 1980s, savings accounts routinely paid 5, 6, even 7%. Your money didn't just sit, it worked a little. Today, the average savings account in America pays around 0.4%. At the same time, inflation has averaged more than 3%. That gap is the first quiet drain. Every year, money sitting in a typical bank account buys less than it did before. Not dramatically, not overnight, just enough that you don't notice until years pass. But that's only the surface. Because the real mistake isn't low interest. The real mistake is believing your bank account is neutral. It's not. Banks are not storage lockers, they're factories. When you deposit money, the bank doesn't set it aside with your name on it. It uses it immediately. Your money becomes raw material. Banks lend it out, invest it, and earn returns far higher than what they pay you. This isn't hidden. It's not illegal. It's the core business model. But here's where the mistake begins. Most people think, as long as my money is safe, I'm fine. Safety feels like the goal. In reality, safety without strategy is expensive, because while your money sits earning almost nothing, the bank is earning a lot. Take a simple example. You keep $10,000 in a checking account all year. It earns 0%. Inflation runs at 4%. That money loses about $400 in purchasing power. No fee shows up, no warning pops up, but it's gone. Now multiply that across millions of households. This is why banks love idle balances. They're silent profit generators, and they design systems to encourage them. Minimum balance requirements, overdraft protection, linked accounts, automatic transfers, all framed as convenience, all quietly discouraging movement. But the real drain shows up when something goes wrong. Let's talk about overdrafts. Most people think overdraft fees happen because someone is irresponsible. That's the story. The reality is much stranger. Many overdrafts don't happen because people don't have money. They happen because of timing. Your paycheck is scheduled for Friday. Your rent hits Thursday night. Your balance dips negative for a few hours. Fee. Even if the money arrives the next morning. Banks used to process transactions in the order they happened. Then many switched to processing the largest payments first. Why? Because it increases the chance of multiple overdrafts. This isn't theory. Banks were fined billions of dollars for it. But even after reforms, overdrafts still generate tens of billions of dollars a year. And here's the irony. The people most likely to pay overdraft fees are not the poorest. They're people with stable income and tight margins, people who are almost fine.
Which brings us back to the mistake. Most Americans use one primary account for everything. Paychecks come in, bills go out, subscriptions tick by, unexpected expenses hit. One bucket, one balance. That makes life simple. It also makes money fragile. Because modern banking is built on precision timing. Miss it by hours, you pay. Now zoom out. While individuals are fighting fees and inflation, banks are benefiting from a larger shift. Interest rates went up fast. Banks raised the rates they charge borrowers almost immediately. Credit cards jumped to 20, 25, even 30%. But savings rates, those moved slowly, very slowly. That difference is called net interest margin. It's basically the spread between what banks earn and what they pay you. And over the last few years, that spread exploded. Translation, banks made more money per dollar you left sitting. The mistake isn't having a bank account. The mistake is treating it like a destination instead of a transit point. Money is not meant to sit still in a high inflation environment. When it does, someone else benefits, and that someone else is usually the institution holding it. Now, here's where it gets uncomfortable, because even people who know this often still do it. Why? Because banks sell peace of mind. The app looks clean, the balance is visible, the money feels real, moving it feels risky, investing feels complicated, high-yield accounts sound like work, automation feels scary, so money stays put, and the drain continues. There's a quiet absurdity to this. Americans obsess over couponing, cashback apps, and rewards points. They'll drive across town to save $5 on groceries, but leave thousands of dollars sitting in accounts that lose value every day. Not because they're stupid, because the system makes inaction feel safe. Now, consider this. If inflation averages 3% for 20 years, money loses nearly half its purchasing power. Half. That's not a crash, that's erosion. And erosion doesn't trigger panic, it triggers complacency. This is why the mistake is so powerful. It doesn't hurt loudly, it hurts politely. Now zoom out further. What happens when millions of people make the same quiet mistake? Households feel poorer even when incomes rise. Savings feel harder despite working more. Debt fills the gap. Credit cards become survival tools instead of convenience, and banks earn twice, once on idle cash, again on high-interest debt. That feedback loop is one of the defining financial dynamics of the last decade, and it's why so many people feel like they're running in place, even doing everything right. The hype says, just budget better, just cut lattes, just be disciplined. Reality says the system punishes passivity, not dramatically, relentlessly. Now, here's the part most videos don't talk about. This isn't just a personal finance issue, it's a systemic one. When money pools in low-yield accounts, it concentrates power. Banks decide where capital flows, who gets credit, at what price. Meanwhile, households absorb inflation risk alone. No negotiation, no opt-out. And when people finally react, it's often too late. They chase returns. They take risks they don't understand. They move money emotionally instead of strategically, all because it sat idle for too long. So what's the takeaway? Not a checklist, not a hack, just a question. Why do we treat one of the most active forces in the economy, money, as if it's supposed to sit still? Why does doing nothing feel safer than intentional movement? And who benefits when millions of people believe that? Because the biggest banking mistake in America isn't overdrafting, it isn't missing payments, it isn't bad math. It's assuming that leaving money alone means leaving it untouched. It doesn't. It's being touched every day, just not by you. And the longer that assumption goes unchallenged, the more expensive it becomes. So the next time your balance looks calm, the next time nothing seems wrong, ask yourself a simple question. If my money is working, who is it working for? And is that a choice or just a habit we were all taught not to question?
The information provided in this video is for educational and informational purposes only and does not constitute financial, investment, or legal advice. I am not a licensed financial advisor. Investments involve risk, and you should consult with a qualified professional before making any financial decisions.